What's up, guys? It's Nathan here. It's clear that Australia's major banks align on one particular view, and that is when it comes to pointing fingers for the decrease in shareholder value, which is a consequence of the mortgage wars which have reduced returns, and given Macquarie, a rising competitor, a prime opportunity, no one is willing to accept responsibility. Every chief executive officer adopts a defensive posture of being an unwilling participant that was dragged into the competition that they didn't initiate. The blame lands on the shoulder of two banks that missed out on the swell of the Reserve Bank's term fund facilities, also known as TFF. The TFF was a catalyst for the boom in fixed rate loans, which were ultra low at 1.99%, 1.94% we saw, and this wave is currently transforming into a fixed rate mortgage cliff. Both ANZ and Westpac, however, were unprepared and lost significant market share during the pandemic. The recovery strategy for these major banks, given the slowdown in growth in new lending, appears to be rooted in their cashback offers. These offers initially served to steal market share, but they actually spiraled out of control. Despite the fact that their economic feasibility was doubtful, other banks had to adopt them in order to retain their market share. These cashback offers are despised by investors, as the dissatisfaction was likely the driver behind the Commonwealth Bank's recent decision to cancel their $2,000 cashback from the market in June. This move signals a shift towards prioritizing returns for shareholders and fairness for all customers. In fact, Commonwealth Bank went beyond the Reserve Bank's recent rate rise of 0.25% in May, rising the price for new loans by another 0.1% in an effort to bridge the significant gap between prices offered for new customers and the higher rates existing customers pay. And if you find value in this video, please consider hitting that subscribe button, as it really does help out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. The current market environment is placing greater scrutiny on net interest margins, and there's pressure for banks to maintain a stable return on capital. This discontinuation of cashback offers is a significant step towards recovering some of these returns. This change is reflected of the normalization of bank behavior to restore net interest margins in response to the intense competition that drove down pricing. Now, every bank profited variably from the disparity between what they paid customers for deposits and what they charged for new loans. This enabled the banks to absorb the discounts and expand or maintain their mortgage share as competition drove their smaller non-deposit taking counterparts out of the market. But now, as deposit rates are becoming more meaningful enough for customers to seek better deals, the tables are turning. This shift is catching up with banks who have been slow to pass on deposit rate hikes. The questionable loan economics of cashback offers has been sustained by the arbitrage on cheap deposits. However, the banks are now starting to transition of the cheap funding that they secured through the short-term term fund facility, which allowed them to borrow at effectively 0.1% or 10 basis points. In response to the Australian Consumer and Competition Commission inquiry into the bank deposit setting behaviour, banks have started to become more generous to savers. Discount pricing for new loans and upfront cashbacks are starting to fade away. On this note, National Australia Bank announced its decision to withdraw its cashbacks from the market in the end of June, which is really following Commonwealth's lead. The speculation is now that ANZ may follow suit, considering its foray into the cashback market, which was a strategy to safeguard its market share, but has now firsthand witnessed the detrimental impact it's had on its bottom line. However, ANZ is confronted with a tricky situation. While it might be beneficial for them to curb its cashback offerings, it needs to prove to the Australian Competition and Consumer Commission that the big banks don't uniformly follow each other's mortgage strategies. This is especially crucial as ANZ is seeking approval for its Suncorp acquisition, which could potentially affect its decision-making process here. Commonwealth Bank, which holds over a quarter of the entire mortgage market, has reported its growth is decelerating to match the market pace in its third quarter update. This implies that it's focusing on maintaining its market share rather than expanding it, as it aims to guard against unprofitable growth. Even Macquarie, which has arguably been the fastest growing and most aggressive competitor in terms of capturing market share, has eased its pace. In its full year report, it highlighted that the growth rate within new mortgages have slowed in the March quarter. Macquarie, which now represents 5% of the mortgage market, has never resorted to cashback offers. It's also worth noting that its new loans were primarily funded by a significant 30% growth in deposits. Cashback strategies were seen as an immediate solution to regain lost ground for many banks, but they've turned into a self-defeating prophecy with unsustainable economics. As the market transitions, banks seem to be rethinking its strategy, focusing on more sustainable growth and maintaining shareholder value. This is a promising shift towards a more balanced and fair banking industry, where banks compete on rates, product offerings, and turnaround times rather than resorting to short-term tactics. This is a kind of competition that is healthy for the banking industry and more beneficial for customers in the long run. To grasp the forward-leaning vision of Macquarie in its financial sphere, we need to understand the guiding principles: profit and return on capital. The investment banking roots of this firm are evident in their approach to conducting their business, which is what sets Macquarie apart in their ability to meticulously analyze loan profitability, as they'd recognize that cashback offers primarily drive in rate-conscious clients, which typically accumulates in less profitable outcomes. Another fact in Macquarie's agility in the market is its lack of investment in physical retail branches. This aspect is undoubtedly contributed to their flexibility, but more importantly, they aren't alone in this advantage. One key player in the market, particularly online lenders such as ING Bank and UBank, have been notably aggressive in their approach as well. These lenders, which are unencumbered by financial burdens of physical infrastructure, have been able to offer competitive pricing and significant cashback offers to successfully drive up market share. UBank's ability to handle increased volumes of business, particularly after their seamless transition and integration of their 86400 acquisition, underscores the strengths of their systems. However, the question arises, where does the industry go from here? I guess the key theme will be depositors becoming more savvier. This disparity between Commonwealth Bank's mortgage and deposit growth serves as a case in point. Despite Commonwealth Bank's mortgage portfolio expanding at market pace, its deposit growth is lagging behind, achieving only 0.7 times the market or system pace in the third quarter. This discrepancy is an indicator of the rising competition in the sector. And remember to like, share, and subscribe to stay informed with all things property and finance. Since the global financial crisis, there has been a shift toward deposit funding, which is expected to counterbalance short-term pressures. The critical question remains whether the big banks, with their online savings rates, which are a modest 1.95 to 1.3% respectively, will be able to retain customer deposits without increasing their rates. In comparison, Macquarie rate stands at an attractive 4.5%. The increased scrutiny on net interest margins and the need to ensure sustainable returns on capital will ensure that the banks will not resort to irrational pricing. It will encourage them to be more generous to savers and thus creating a more balanced and fair market to all stakeholders. Here at Hunter Galloway, we're mortgage brokers and can assist if you're looking to get into the market and understanding the mortgage process. There's no cost for our service and we work with people Australia-wide. So reach out with us at huntergalloway.com.au where you can fill in a contact form and we can get in touch and undertake a free assessment, or call us directly on 1300 088 065 and we'll see you next time.